Hey friends, welcome to the Singapore Market Digest for May 8th, 2025. I'm Iggy from the Investing Iguana, and today we're diving into what's been happening on the SGX. The market has been showing some interesting movements lately, with several key companies releasing their quarterly results. Today, we'll take a closer look at DBS, Great Eastern, and Lendlease Global Commercial REIT, all of which have recently shared important updates with investors. These companies represent different sectors of the Singapore economy, giving us a good cross-section of current market conditions. Let's start with DBS, Singapore's banking giant and a bellwether for the financial sector. DBS just reported their first quarter results for 2025, and there's quite a bit to unpack here. Their net profit for Q1 came in at $2.9 billion, which represents a slight decrease of 2% compared to this $2.95 billion they posted in the same period last year. Now, before anyone gets too concerned, it's worth noting that this dip wasn't due to any operational challenges or weakness in their core banking business. The main factor behind this small decline was actually higher tax expenses, specifically resulting from the implementation of the new 15% global minimum tax that came into effect recently. This is part of the international effort to ensure large multinational corporations pay a fair share of taxes, and it's now impacting the bottom line for companies like DBS. Despite this slight drop in profits, there's actually good news here. DBS managed to beat market expectations, as analysts had forecast a profit of around $2.87 billion. So even with the higher tax burden, the bank performed better than predicted. This demonstrates the underlying strength and resilience of DBS's business model, even in the face of changing regulatory environments. In terms of market reaction, DBS shares closed at 42,076 taels yesterday, down just 0.5% or $1.23. This relatively modest movement suggests investors weren't particularly concerned about the slight profit decline, likely because they understand it was tax-related rather than due to any fundamental operational issues. For long-term investors in DBS, the bank continues to show the stability and performance that has made it a cornerstone of many Singapore investment portfolios. Now, let's shift our focus to the insurance sector with Great Eastern, one of Singapore's leading life insurance providers. Great Eastern delivered some truly impressive numbers in their first quarter results. The company posted a profit of $345.5 million for Q1, which represents a robust 13% increase compared to the $306.7 million they earned in the same period last year. This double-digit growth came from two main sources, showing strength across different aspects of their business. First, their core insurance operations performed well, with profits from the insurance business rising 4% year-on-year to reach $246.8 million. This indicates healthy underwriting practices and steady demand for their insurance products. But what really supercharged their bottom line was the strong investment performance in their shareholders fund, which jumped by an impressive 40% year-on-year to reach $98.7 million this quarter. This demonstrates Great Eastern's skill, not just in selling insurance policies, but also in managing their investment portfolio effectively in what has been a somewhat challenging market environment. It's worth noting that insurance companies like Great Eastern essentially operate two businesses in one. They sell insurance products to customers, but they also manage large investment portfolios using the premiums they collect. So seeing strong performance on both fronts is particularly encouraging for investors. Despite these positive results, Great Eastern's shares closed flat yesterday at $25.80. This might suggest that the market had already anticipated strong performance, or perhaps investors are taking a wait-and-see approach before reacting to these quarterly numbers. Either way, the fundamental performance of the business appears strong based on these latest figures. Turning our attention to the real estate sector, Lendlease Global Commercial REIT, commonly known as LREIT, shared their third quarter business update yesterday. And there are definitely some bright spots here, despite the challenges facing the broader retail landscape. LREIT achieved a positive retail rental reversion of 10.4% for the quarter ended March 31st, 2025. For those who might be unfamiliar with this term, rental reversion refers to the change in rental rates when leases are renewed or new tenants come in. So, a positive figure of 10.4% means they're securing significantly higher rents on new or renewed leases compared to the previous rates. This is a strong indicator of the value and attractiveness of their retail properties. What makes this particularly impressive is that LREIT managed this strong rental growth despite facing some headwinds in the retail environment. They reported a slight 0.2% decline in visitation and a more noticeable 5.1% drop in tenant sales year to date. These softer numbers were attributed to general retail conditions, increased outbound tourism taking spending overseas, and specific weakness in certain retail categories, including shoes and bags, and fashion and accessories. The fact that LREIT could achieve double-digit rental reversions in this environment speaks volumes about the quality and positioning of their retail assets. Their portfolio continues to show remarkable resilience with an occupancy rate of 99.5%. Which is essentially full occupancy when you consider the natural turnover in retail spaces. They also maintained a healthy tenant retention rate of 87.9% by net lettable area, indicating that despite some challenges in retail spending, tenants still see significant value in maintaining their presence in a REIT's properties. Units of Lendlease Global Commercial REIT closed unchanged at 500 acres yesterday before the business update was released. It will be interesting to see how the market reacts to these numbers in today's trading session. Looking at these three companies together provides us with some valuable insights into different sectors of the Singapore market. DBS shows that even market leaders can face headwinds from regulatory changes like new tax regimes, though their core business remains fundamentally strong. This is something we might expect to see affecting other large corporations as global tax standards continue to evolve. Great Eastern demonstrates how a diversified approach with both operational improvements and investment gains can drive significant profit growth even in uncertain economic times. Their performance highlights the importance of having multiple revenue streams and the value of effective investment management. And LR REIT highlights the resilience that can be found in well-managed real estate portfolios, even when consumer spending patterns are shifting. Their ability to maintain high occupancy and secure rental increases despite some softness in retail sales suggests that prime commercial properties continue to hold their value, even as the retail landscape evolves. Together, these updates paint a picture of a Singapore market that has its challenges, but also shows significant areas of strength and resilience. For investors, it's a reminder of the importance of looking beyond headline numbers to understand the underlying factors driving business performance. As we move further into 2025, we'll be keeping a close eye on how these trends develop and what they mean for your investment decisions. Will DBS find ways to offset the impact of higher taxes? Can Great Eastern maintain its strong investment performance? And will LREIT's retail properties continue to buck the trend of softer retail conditions? That's the scoop for today. Remember to do your own research before making any investment decisions. This is Iggy from the Investing Iguana, signing off.